Good afternoon. Welcome to IMC Chamber of Commerce and Industry MCX webinar, which is an ongoing series of events. Today we are going to discuss commodity market fundamentals relating to agricultural commodities. We have the pleasure of IMC President, Mr. Zuzar Khurakiwala's presence, and I request IMC President to kindly deliver the presidential welcome address. Sir, the floor is yours.
Thank you. Is my video on?
Yes, sir.
Okay. Good afternoon to all of you. It gives me immense pleasure to welcome each one of you to this interesting Commodity Fundamentals Forum, Agri Commodities, organized by the Indian Merchants Chamber in association with MCX. IMC and MCX are conducting events jointly from time to time to deepen and widen the Indian commodity derivatives market. This market has huge potential for growth as commodities touch our everyday life in one way or the other. Agriculture commodities, edible oil, cotton, sugar, grains, etc. are all assigned a weight in the price index. Prices of these commodities have a bearing on the rate of inflation. Importantly, as our economy integrates with the global economy through the trade and investment route, our domestic commodity market is increasingly influenced by development in the global.
So please unmute.
To be able to read the emerging market trends reasonably correctly and thereby make informed trading and investment decisions. Whether as a producer, as a processor, or as an industrial consumer or trader, those with exposure to commodities have to constantly monitor the market. This is especially important for those who take forward trading positions. Therefore, market outlook or a view of the likely behavior of the market becomes very important. While several drivers impact the market, a study of the supply and demand fundamentals is the key. So what should market participants expect in 2022? I think the outlook for the global market for the first half of 2022 is mixed. The market is torn between demand concerns and supply side issues. It is necessary for stakeholders to have a clear view of the dynamics and direction of the agri market. Friends, today we have lined up expert and excellent speakers with domain expertise, representing some of the well-known names in their insights into the market dynamics are sure to benefit all participants. I'd like to welcome Mr. Madan Sabnavis, Chief Economist, Bank of Baroda, Mrs. Rajni Panekal Lamba, VP, Phillip Capital India Private Limited, Mr. Sunil Kumar, Senior Product Manager, Agri Commodities, MCX, and our own Mr. G. Chandrasekhar, Economic Advisor, IMC and Director of IMC ERPS. Before I conclude, let me give you a brief about the Indian Merchants Chamber, which is the premier chamber of commerce and industry in the country with a rich legacy spanning over 100 years of excellent service to trade, industry and commerce. It is membership of over 5,000 members and 150 trade associations. We connect to almost 400,000 businesses and industry establishments across the country with diverse sectors. Through its various 26 expert committees, the IMC provides policy inputs for the government, both central and state, and is continually engaged in interaction with policymakers at various levels. Once again, importantly, I wish to mention here, before I end, that IMC is a SEBI-accredited training institution for conducting awareness programs on commodity derivatives. Once again, I welcome you all to this interesting seminar, and I'm sure there will be take-home messages for all of you. Have a great evening filled with learning and knowledge. Thank you very much. Over to you, Mr. Chandrasekhar.
Thank you, sir. Thank you, Mr. President, for this wonderful welcome address. You've actually set the tone. I will now take over and make a brief presentation. Friends, just bear with me for a few seconds. Let me share screen. Yes, here it goes. Slideshow. Okay. All right, here we go. This is the IMC MCX webinar on commodity market fundamentals, fundamental forum. We do these events from time to time. We cover IMC and MCX together, look at energy market, look at precious metals market, we look at base metals market, and of course we look at agriculture markets. And today's event is on agriculture. And let me simply reiterate what our president mentioned a little while ago, that IMC is a SEBI accredited training institution for commodity derivatives. There are some 20 odd institutions across India which have been recognized by SEBI, and almost all of them are educational institutions. IMC is the only chamber of commerce in India which has this distinction of SEBI accreditation, and we are quite proud of it. Okay, let's go to the next slide. Okay, let me start talking about some of the key drivers of global and Indian commodity markets. This is by no means an exhaustive list, but these are key drivers which all of us have to bear in mind. First one is economic growth. There's a positive correlation between economic growth and commodity consumption. Some commodities are particularly known as growth commodities. As economic growth takes place, commodity consumption or commodity demand also goes up. For example, steel is a growth commodity. Crude oil is a growth commodity. Copper is a growth commodity. Cotton is a growth commodity. Okay, as economic growth takes place, consumption or demand for these commodities also starts to rise. Therefore, we need to start tracking economic growth across geographies to get a fairly good view of the demand scenario for various commodities. The second driver of commodity markets is geopolitics. And when we talk of geopolitics, we normally refer to a political instability, a war-like situation, which usually drives up the crude oil market. Okay, primarily because there are risks of supply disruption. And when this geopolitical instability centers around MENA region, which is Middle East, North Africa region, it obviously raises the risk of crude oil supply disruption. What is happening currently between Russia and Ukraine? Again, it's impacting the energy market very, very clearly, and therefore we need to track geopolitics and its impact on crude oil prices and whose impact on commodities, etc., etc. Third factor that we need to track is a monetary policy. At the moment we have a fabulously accommodative monetary policy across the world in all major economies. It's going to change. The situation is going to change. The signals are very clear. But yeah, a very liberal monetary policy, accommodative monetary policy, too much of liquidity in the economy, low interest rates actually drive all the markets, all the asset markets up. Of course, they drive the commodity markets also up. And once this monetary policy starts to normalize, then obviously it will have a kind of negative impact on the commodity market, which is what we are seeing at the moment. Okay. Then you have currency. Primarily, we have to look at the dollar. When the dollar is weak, it props the commodity prices up. And when the dollar gets stronger, obviously the upside risk to commodity prices is substantially reduced because of a strong dollar. Then for agriculture, the most important driver is weather. And whether you have normal weather or whether you have phenomena like El Nino or La Nina, obviously will impact agriculture production, and therefore they'll impact agriculture market prices. But we need to track weather, and there is enough and more data available on each one of these factors: economic growth, geopolitics, monetary policy, currency, and weather. What did we find in the last quarter of 2019? We found La Nina in South America. La Nina in Asia brings excess rainfall, whereas the same La Nina when in South America has a negative impact and actually brings dryness. And then in 21, we have again seen dry conditions in South America because of La Nina 2 years in a row. Okay, and therefore that's affecting crops. I'll come to that a little later. But weather is an important driver of the market. Last but not the least, the funds. Okay, the pension fund, the mutual fund, the speculative capital primarily to put it in a nutshell. But the funds actually track the preceding 5 key market drivers, and then they take a call where to invest and how much to invest, etc. And therefore, these are the key drivers which we need to track when we want to have a reasonably good view of commodity markets.
Sir, sorry to interrupt. We can't see the slides.
Sorry?
We can't see the slides. Can you please start the slides again?
Okay, all right. What will I do? I thought I started to share. Stop sharing. What should I do now? Share screen again. Okay. Oh, I need to click that share. Is it visible now? Is it visible now?
It's visible, but I think when you move it, it should move. Yeah.
Yeah, it'll go now. It'll move. It'll move. Okay. All right. Is it? Yeah. Okay. Is it okay? We're gone. Okay. Now let's come to the next slide. The best part, there are the 6 drivers that I talked about. Now there is a 7th dimension to all this. What is that? Actually, the 7th dimension now is supply disruption to the global supply chain, which is what we have seen in the last 2 years. Shipping problems, shipping costs have gone up, and shipping issues have become quite entrenched. And the world was hoping that in 2021 itself, the shipping problems will be resolved, non-availability of containers, etc. But it's still continuing, and therefore there's a new dimension which is impacting commodity markets and commodity prices, which is the logistic problem and supply disruption because of the logistic problem. Actually, the current situation that we are facing reminds me of 2010, 2012 years. I remember I wrote extensive commentary on the markets during those years, and all those drivers of the market, those 6 drivers that we talked about in the previous slide, are all operating simultaneously today. They operated once in 2011-12, and they're all operating today exactly 10 years later. I don't know if it's going to be a pattern, but we are seeing, and I find it quite a strange coincidence that all those drivers of the market are operating simultaneously. And therefore, the markets currently, commodity market, the agriculture markets are buffeted, as I would call, by all these drivers operating simultaneously. What is the result? The result is that agriculture commodity prices are at a fairly or substantially elevated levels. Vegetable oil prices have reached record highs. Cotton prices have become cotton has become very expensive. Corn, wheat, you name the agriculture, soybean, you name the agriculture commodity, major commodity, and the prices are elevated. Now this price elevation is worsened by high crude oil prices, because crude oil is a universal intermediate, and when you have high crude oil prices, it does impact the cost of production of agriculture commodities, primarily through the synthetic fertilizer route, and of course the cost of mechanization, cost of processing, cost of transportation, etc. And the supply chains are also recovering rather slowly. That's adding to the supply problems. Economic activity is rebounding now in the last 2 or 3 quarters that we've seen, and that is adding to the demand pressure. And then you have the geopolitical tension, which has kept the crude oil prices very, very elevated, closer to $100 a barrel. More important is the weather factor. The second year in a row, 2021, end of 2021, like we had end of 2020, South American crops are down because they're facing adverse weather conditions. November, December, both Brazil and Argentina faced absolutely dry conditions, which is impacting the soybean crop, the corn crop, the wheat crop, etc., etc. Therefore, that's why commodity prices, agri commodity prices, are substantially elevated. Okay, come on. Okay, now what is happening in the what's happening in South America is extremely important. Brazilian soybean crop, because of the effect of La Nina, which brings dry conditions there, is down by 10% to 125 million tons. It was 140 million tons last year. There's a big drop. Corn crop is down, and therefore we have tighter supplies and lower stocks of major agriculture commodities. And then you have the conflict between Russia and Ukraine, which has elevated the risk of supplies of wheat and sunflower oil. These two countries, Russia and Ukraine, are very large producers and exporters of wheat, and therefore there is a risk that that supply might get disrupted. Same with sunflower oils. Therefore, sunflower oil prices are also substantially elevated at this point of time. Look at Malaysia and Indonesia. Prices in Malaysia last week touched a record 5,250 ringgits, or whatever that price was, Malaysian ringgits. Record price, unheard of, unseen, and it was never imagined that market would go to this kind of level. But primarily because of a very tight supply situation, and there's a labor shortage in the plantations in Malaysia. So that's the reason why agriculture commodity prices are currently substantially higher than they were even 1 year ago. Now let's talk about cotton, both the global and Indian situation. Again, the fundamentals are tightening very clearly. Prices are at a new high, well above, I think 114, 115 cents a pound. I don't track it daily, but I know prices have gone to record levels, very, very high levels. Why has that happened? Because global output at 26.1 million tons, I'm talking in terms of tons here, production. And if you want in bales, simply multiply by 6, and then you will get as number of bales. Global production of cotton in 21-22 is 26.1 million tons, but that is lower than the consumption, which is obviously 27 million tons, and then therefore the end stocks will also be down. All this is sending a message to the market. The fundamental numbers of this market are sending a message to market participants, and obviously market participants take a position based on this. Same with Indian situation. Our output this year is lower than it was last year. Our mill consumption demand is higher this year than it was last year. Our exports will obviously be lower this year than they were last year. And we are also importing lower quantities. Last year, if I remember correctly, it was 1.5 million bales import. But this year it will be only 1 million bales import because global prices are very high. And our own end stocks are going to be substantially lower, multi-year low numbers. And then look at another factor that is impacting agriculture commodities. The government of India's agriculture ministry's Rabi crop estimates. They were announced last week. My personal belief is that some of the numbers are overstated. And we have seen it happen in the last few years, whether it is pulses production or oilseeds production. I believe these numbers estimated by the government are to a large extent, they are overstated to some extent. That's very clear. And I always believe the market is the final arbiter. The market knows best what is the production. The market knows best the fundamentals, the demand, supply, and demand fundamentals. Therefore, the market's view is what is final. There is one Gujarati saying that I'm reminded of. In the trading parlance, they call it Bhav Bhagwan Che. Price is God. Price is the final arbiter. The market is the final arbiter, and price, you can't challenge prices, market prices. Okay, and then therefore we need to understand that the fundamental numbers themselves are under challenge to some extent. Now, given all the situation, what is the outlook? What is the outlook for 2022 will be a big question. My own sense is that inflation, all of us know there is inflation across the world, including in the mighty United States, which is a several decade high inflation. Inflation is there everywhere, driven by high asset prices, high crude oil prices, high agriculture commodity prices, high base metal prices, etc. And therefore, to beat this, the central bankers are all now beginning to tighten their monetary policy. The US Fed has already announced a policy which will be implemented. Now, what is important is we also have to understand the current high prices, particularly of agriculture commodities, are sure to hurt growth in demand. Don't expect any big growth in demand in 2022. 2020, there was demand destruction. In 2021, we had growth in demand, but that growth will be substantially moderated in the year 22 because of high inflation. But at the same time, there's a flip side to the coin. These high prices, current high prices of agriculture commodities, are sure to encourage larger and larger acreage for major crops, particularly in the northern hemisphere. For the upcoming 22-23 year, there'll be my expectation is that the planted acreage will expand, and therefore there'll be more production. Subject to normal weather, there'll be more production for 22-23 year. But input costs will also rise because of high crude prices and logistics issues, etc. So we need to bear in mind all this. Therefore, in a nutshell, to sum it up, agriculture markets, in my view, are going to stay very volatile. Certainly in the first half of this year, 2022, we are already closer to the end of 2 months, and then you still have the next quarter to go. But the markets are likely, in my view, therefore it is important for value chain participants to manage their price risk, and therefore they need to hedge their price risk. Most unfortunately, of course, for whatever reason, the government of India suspended some of the derivatives contract, and my own belief is that in April sometime these contracts will be brought back and listed again, is my sense. And there's a strong case for bringing these contracts back, or lifting the restriction or suspension of contract. So with this, I will stop, but I must mention that I'm not a trader. I don't hold any position anywhere, either in the physical market or in the derivatives market. I'm a student of the market. Often I'm also a teacher of the market, and that's what I do. And therefore, this is a disclaimer I always issue when I make a presentation on commodity market. Thank you very much. Good luck. God bless you all. I'm now going to invite Rajni Panikar, Vice President, Phillip Capital, who's been closely tracking these commodities, both the physical side and the derivative side, closely, and she has fantastic insights into the market dynamics, and I'm sure she's going to share her thoughts with us. Rajini, the floor is yours.
Thank you so much, sir. After that very in-depth analysis that you have given, frankly, I have very little more to share. What perhaps I will do is get in, since you've covered most of the macros comprehensively, maybe I will just take you through some of the micro that we could look at, specifically for two of the agri commodities that is traded very actively on MCX. One is cotton, and the other is, of course, palm oil, but no longer active right now. It's in suspension, but I will briefly cover edible oils as well. So that is what my agenda for this evening is. And then after that, if there are any questions, I would be happy to take. So I will just share my screen. So please bear with me. And share screen.
Is it on your desktop?
Yeah, I'm on a desktop. So
Share.
Yeah. That again. Is it visible? Is the
Not
screen?
yet.
No.
Okay.
Yes.
Yeah, that's right. Okay.
You can see.
Okay. Okay. All right. So I will now put off the video so that, we could have better clarity when I talk. Okay. Is my voice audible? Yes, Anita?
Yes, it is. Yes, it is.
Right.
Yes,
Right.
ma'am.
Okay.
Go ahead. Please
Okay.
go ahead.
I'll just go ahead. So Phillip Capital are members of the commodity exchanges here in India as well as overseas. Phillip Capital is headquartered out of Singapore. We are about a nearly 50-year-old firm, and we've been members of the commodity exchanges, the equity exchanges, and like I said, on all major global exchanges. And we are intermediaries, and we provide access to all derivative markets, whether it is commodities, currencies, equities. So that's our brief introduction. Like I said, Chandrasekhar sir has very well covered most of the macros that you need to track when it comes to agri commodities. I just have a few slides on cotton and edible oils and what is happening in those sectors. You would have heard it in the news. It's almost discussed actively on all media channels, print media. So I will just take you through some of the details on the fundamental sides that is impacting these two largely traded commodities on MCX. Yes. Yes, so both these commodities, like Chandrasekhar sir was saying, have international benchmarks because of the linkages on the trade side. We are exporters and importers of cotton. As and when the price is in our favor, we export. When it is not, we are importers. But therefore, cotton prices largely gets impacted with what happens on the international forum, especially the ICE cotton futures. And on the edible oils, we are importers of edible oil. 65% of our edible oil requirements are met through import. So huge linkages that happens there. What I have tried to put in this particular slide is that since about, all the macros that was discussed, for cotton and edible oils, perhaps the three that stands out currently that has been influencing prices and perhaps has cost the last $200, $300 rally in edible oils boils down to three major factors, which is currently actively in play and could continue, I think, very well into the first half. And there are a lot of uncertainties on that. First is, of course, the Russian-Ukraine crisis, very well covered by Chandrasekhar sir. Its impact. When it comes to cotton, it's obviously, this Russian crisis has resulted in crude oil prices going up to 90+ levels. We don't know where this could end. Just yesterday, there was further escalations, which further resulted in another $2, $3 rally in crude oil. Now, what happens is when crude oil rallies, cotton also gets support because man-made textile cost escalates. So that's how cotton finds that linkage with crude oil prices going up. Edible oils, of course, has a biodiesel scenario. So when crude oil prices go up, for biodiesel, which is what edible oils is also used to, favorably finds a demand push, so to say. But at current edible oil prices, which is at record high, it is not perhaps so one-on-one, but still we do see crude oil prices rallying and edible oil prices rallying. So this factor is very volatile, and it will continue to remain volatile because we don't know how it ends. Does it result in a war? Does it result in a pullback? And therefore, this particular crisis is going to keep cotton and edible oil prices volatile and on the roll for the foreseeable future. Then the second factor, which was covered also, is of course what is currently happening for the last 2 seasons and has a huge impact on vegetable oil prices because oil seeds gets impacted by the drought that we're currently seeing in La Nina. In fact, the South American oilseed production has now been brought down to close to 190 million tons from about 200 million tons just in June of 2021. So in this one particular season itself, we've been seeing 10 million ton reduction in the last 6-7 months. And Argentina, which gets into harvest only in April, we might further see some revisions. So the impact of drought is actually not clear, and we continue to see revisions. if we continue to see revisions, then this could be another factor that could keep oilseeds and therefore edible oil prices on the road. Another factor which can come into not geopoliticals, but perhaps government intervention, similar to what we've seen in India when it comes to duty reductions for edible oil. Indonesia is the third factor that has added to edible oil price getting support, because Indonesia, like India, goes into election in 2024, and palm oil prices are record high. I mean, palm oil was 3,500 ringgits just a year ago. Currently, it's nearly flirting with 6,000 ringgits. Now, these are record high prices in palm oil, and the inflation impact has resulted in Indonesia bringing about a very restrictive policy whereby all the exports out of Indonesia, the exporters have to put in 20% of whatever quantity that they sell in exports as domestic supply. They have to ensure that. Now, in a tight year, which was previously discussed as well, in a tight supply year for edible oils, when the largest producer of palm oil, Indonesia, makes such restrictive, makes such strong restrictions on supply, that's a huge blow. And that has also resulted in the price of palm oil reaching new highs. And these three factors currently control on the macro front that was earlier discussed. These three factors are definitely at play currently for cotton and edible oils. Now, if I have to quickly dig down into the supply and demand for cotton, which Chandrasekhar sir also covered, I think what is most important is the fact that cotton arrivals have been lower by 30 to 35% so far this season. We've just had about 150 lakh bales or so come in as arrivals. And we've seen, as in the first point that I have written here, that there has been a constant downward revision of our production estimate. It was about 360 lakh bales in December 2021. It has now come down to 348. And given that, at 348 lakh bales, we are still now lower or round about what was last year's crop, but the arrivals being 30-35% lower, therefore the jury is still out. Is it farmer holding or is it lower production? We could be somewhere in between, and this means that because we don't have the right supply numbers, if we go by the fact that arrivals have been lower, this does add a supply shortage kind of a scenario for cotton, which is what is keeping prices high. And of course, whatever is happening on the international markets with prices of ice cotton nearly there at 120 cents a pound. If these escalations between Russia and Ukraine continues, it could breach it. Given that strength in international markets, plus the shortage of arrivals or lower arrivals this year, it is definitely adding to prices going up. And that is what we are seeing. Cottonseed prices climbing to 11,000 rupees per quintal. Cotton, ginned cotton getting offered at 80,000 rupees per candy. And still farmers are hopeful because they closely monitor what is happening on ice, that, prices could rally higher and could be one of the reasons why they are selling less. Lower production also, but we still have to wait till end of March to see whether we see any increase in supply or there will be a lower production, revised production numbers will be revised lower. Now here I have just put in the S&D, which is by the Cotton Association of India, which was also shared by Chandrasekhar sir. So we have lower supply in terms of production, in terms of opening stocks, in terms of exports. We definitely are going to see lower exports, and the reason being that currently the India cotton prices are expensive compared to ice cotton by 10 to 11 cents. So this puts India exports at a disadvantage, and despite the imports duty of about 10%, we are seeing growing demand for imports that is happening. So we do expect, and that is what Cotton Association of India is saying, that we do expect about 15 lakh bales of imports this season, higher than last year, because we are seeing good mill demand, and that is perhaps what continues to fuel even global prices, because our mill demand is good. On the export side, there is 48 lakh bales that is expected, again 78 lakh bales. but this also could be revised lower. So perhaps there we might see an increase in closing stocks, but for now, definitely the closing stocks is estimated at about 45 lakh bales, which is definitely much lower than last year. Therefore, clearly a supply driven rally that is happening both on the domestic and in the international front. If we have to quickly look at where perhaps all this will result into, as shared by Chandrasekhar sir again, higher prices should encourage acreage. And this is what we are expecting, that the coming season of 21-22 should see acreage increasing by about 12 to 15% compared to previous year. And this cotton production, this could result into cotton production increasing to about 360-375 lakh bales the coming season. And this will of course be aided right now by SkyMet saying that India could have normal monsoons. So the nutshell is that higher prices results into higher production. Of course, the disclaimer here is that weather remains favorable, and that is what we expect for cotton as well. In terms of edible oils, like I said, it's imported inflation mostly. So if I have to quickly look at the S&D for 21-22, we were expecting our import requirement to marginally decline or remain flat. This is because we were expecting about 500,000 ton increase in our domestic production. And therefore, that was going to take care of our incremental demand in edible oils. But unfortunately, when we look at what has happened in the first quarter of the oil year, which begins from November and ends in October. So for November 21 to Jan 22, the actual edible oil imports has been 3.48 million tons, and there has been actually a jump of 5.5% over the previous year. And the reason for this again is similar to what is happening in cotton, that despite a larger estimate of oilseed production, arrivals have been low. Whether we've got the number wrong, whether farmers are holding on to it, expecting higher prices is again a question that is not very easy to answer again for oilseeds and majorly for most commodities, because the production numbers put by the government definitely is not getting reflected in the supply numbers here. And therefore, we've had imported oil inflation, and this particular chart here, which is from the Solvent Extractors Association, puts the the rally of oil prices very clearly here. We look at crude palm oil, soybean oil, sunflower oil, the largest edible oils that we import. Look at prices, it's 1510, and this is January prices. And as we speak, prices have already gone to 1660. Same for soy oil. And compared to last year, prices are up 50 to 60%. When it comes to edible oil, given our dependent, we continue to face the rot of imported inflation. So what is the fundamental outlook that we want to take it for the next 6 months, because weather will play a large role. So we want to restrict our views for the next 6 months. For cotton, the arrivals, as in the seasonal phase, should come to a close in March. But we expect that given that arrivals have been slow so far, so we might actually could see an unseasonal pickup in arrivals before the peak season ends. This is, of course, a hypothesis that we are working on, and this therefore could bring some downward pressure on cotton, unlike the seasonal phase where usually towards March, as arrivals decline, prices strengthen. But this time, given the lower arrivals and the more or less stable crop production numbers year on year, we are expecting that by March, there could be some selling interest, an unseasonal selling interest from farmers, which is something that we will be monitoring. The domestic mill demand is muted, and unless there is depth correction in prices, imports are happening. But beyond that, at these prices, perhaps we are also expecting some amount of mill demand also to come down. Export prospects remain weak, like I said, because of our strong basis. Therefore, we are expecting the supply disruption or the supply tightness to roundabout ease during the next 6 months. For vegetable oils, the Rabi crop mustard begins its arrivals. It's already started. Arrivals have picked up to about 5 lakh bales a day, which is close to nothing just about a month ago. And mustard seed, for those who are unaware, is a high oil content seed. It has about 40% oil. And we're expecting about, production to be at a record high of about 10.5 million tons from about 8 million tons or so last season. So this should also ease supply, provided the arrivals increase as expected. Malaysia, Indonesia again gets into a seasonal production increase from May onwards, which again should bring down some of the price pressure that we are seeing. Argentina arrivals begins from about April, which also could ease soy oil prices. So these are the micro factors for cotton and for vegetable oils. On the macro side, like we shared, SkyMet is saying that we are going to have normal monsoon, which therefore should, in anticipation of a good crop, good acreage, should bring down the expectation and therefore dampen prices. Also, for both these crops, US being a very large market, for the year 2023, the early surveys are saying that there's going to be an increase in cotton acreage, in soybean acreage. In fact, soybean acreage could surpass corn acreage in US, which is something that has not been seen since about 2018. So these are definitely, like Sir said, bhav bhagwan hai, and therefore this is at play. When prices rises, market also adjusts, cropping pattern adjusts, demand adjusts, supply adjusts, and then prices start correcting. So this is what we are expecting in the next 6 months. We are, of course, not in a position to share our price forecast because it's an exchange program. But this is my contact details. If there is requirement for price risk management, like we said, we are members of the exchange. We work very closely with corporates and value chain participants to hedge price risk on commodity exchanges. Please feel free to reach out to me. Thank you so much for your time and attention.
Thank you, Rajni, for this excellent presentation. Always absolutely focused and top class presentation. Thank you very much once again. You really touched all the fundamental factors. It is so good. 2 points that stand out very clearly. The supply numbers are still not in place as far as our market, Indian market, is concerned. The CAI has estimated cotton output at 348 lakh bales, correct, for this year. Last week, the government of India came up with a second advance estimate where cotton production is 340 lakh bales, which is about 8 lakh bales lower.
Yeah.
And this is something quite surprising.
Correct.
And similarly, on mustard, I just did some small analysis. The Agriculture Ministry's estimate is 11.4 million tons of production.
Yeah.
Last year was 8.6 million tons. To my mind, these are magic numbers. There can never be any magic in agriculture. And the yield is somewhere upwards of 1.3 tons a hectare. I think things don't work that way, but for whatever reason, we look at government numbers. But as I said, the market is the final arbiter. And therefore, the market will decide what the actual supply is and what the prices are. Thank you very much, Rajni, once again. Wonderful. I'm sure there'll be questions we will be ready to answer. I'm now going to invite Sunil Kumar from MCX to share his thoughts. Sunil.
Yes, sir. Good evening, sir. Thank you very much. Thank you for your very nice presentation, Ms. Rajni. It's always nice to hear you and Chandrasekhar, sir. We learned a lot from you during a lot of IMC presentation, and here I got opportunity to speak in front of you and the esteemed audience. My name is Sunil Kumar. I am representing MCX Agri Division. MCX is a national commodity exchange regulated by SEBI. Many things has already been touched upon by Chandrasekhar sir or Ms. Rajni Panikar. I will be speaking largely on MCX Agriculture Commodity Basket. I will introduce you to a little brief introduction of contract specification because demand and supply and fundamentals have already been covered. I will also touch upon a few aspects apart from a few new extraordinary thing which happened. Chandrasekhar sir also touched upon that subject. that is suspension of a few agriculture commodities, 6 or 7 agriculture commodity, including crude palm oil futures. So let me share my presentation with you. I'll switch off my video for a while. Is it visible to everyone?
Yes.
Can you confirm? Okay.
Yeah.
So at MCX, we have 5 agriculture commodity listed on the platform: kapas, cotton, crude palm oil, mentha oil, and rubber. All these commodities are actively trading. However, crude palm oil and cotton have large volume, and other 3 commodities have decent volume, but not great volume as of now. Rubber has been recently introduced just in December 2020, and this is also slowly gathering momentum, and hopefully it will also reach a level where value chain participants will be happy to participate and hedge their price risk. So I'll speak a little bit about the crude palm oil contract, what happened recently. It was also touched upon by Ms. Panikar also and Chandrasekhar also. As we all know, India is very largely dependent on imported palm oil. 97% of palm oil which is consumed in India, 97 or 98%, it is imported from either Indonesia or Malaysia. And there is very high correlation between palm oil and other edible oil consumed in India, like soybean oil, sunflower oil, because 65-70% of edible oil consumption is made through import. So there we are already exposed to global price risk and global price. So the price correlation between international edible oil price and domestic edible oil price is very high, and that is the and in case of palm oil, it's extremely is very, very high. I'll show you one slide where you can see how much aligned we are with this Malaysian and Indonesian palm oil prices. Since the crude palm CPO contract has been very, very successful. It was introduced in 2008, and by the time we reached 2020, CPO crude palm oil contract was the largest highest traded agriculture future in India, and I'm talking about all agriculture future across the country, across the exchanges. So CPO was the #1 in terms of turnover value, and it recorded the highest single day turnover of 1100 plus crore, and it was the highest since CTT was introduced in CPO. Before CTT, single day turnover was even higher, but since CTT was introduced to many agriculture and non-agriculture commodity, volume actually fell, and it was doing around 400-500 crore last year. But it was a single 1100 crore was the largest, highest one. So it was briefly touched. I will just I would like to elaborate a little bit about suspension of CPO and other agriculture products. I'm not going into what was the reason and all, but I'm just putting out some facts here in front of you, esteemed panel and very learned audience here. It was suspended on 20th with effect from 20 December 2021, and suspension is for 1 year. However, as Chandrasekhar is very hopeful about suspension may get preponed or it may be allowed to relaunch in April. We are also hopeful, but for time being, whatever the reason was, but the talk in the market are like this may or may not be related with the price rise or inflation commodity prices. But if you see whether it is yielding any kind of result, we have seen this kind of suspension earlier also, and how it turned out that we have seen when I think 2007-8 around that time also a few agriculture commodity was suspended later on also. This time, if you see 17 December last open market trading happened in CPO futures. That at that time spot market price that is inclusive of duty price of Kandla was 1086, around 1100 rupees, and yesterday's price of CPO in Kandla was 1275. So this is inclusive of price duty price. So already more than 17% rise in just 2 months. And if you take out the factor of import duty, because the import duty was also reduced, import duty I'm talking about agriculture infrastructure development says, because basic duty is already 0. So that agriculture infrastructure development says is reduction was around 2.5%, and that resulted into duty cut of from 84 rupees per 10 kg to 57 rupees per 10 kg approximately. So if you take it out, the price change since 17 December is more than 21%. So my point here is we can see the price of the commodity ultimately decided by the demand and supply. So you are the better judge. You understand what I'm trying to say here, that price, that suspension of the contract, and if the commodity supply is not increasing, demand is still there, the price continue to rise that we have seen. And what transpired the price rise that has been already discussed and explained by Ms. Panikar and Chandrasekhar sir. So I'm not repeating, just a few highlights. Like labor shortage were it was a very crucial stage in Malaysia, Indonesia. The palm harvesting could not continue as normal. There are shipping logistic disruption. Indonesia mandate of 20% as already discussed. The weather concern, these things are already discussed. So the fundamentals of commodity supply and the sudden rise in demand also we have seen, especially in case of cotton that we'll see. So that is actually not helping to cool down price. No suspension, prices continues to rise. And we have also seen some talk about market talk about any demand. Even some demand from some quarters to suspend cotton from the derivatives market also. So if you see what has happened in CPO, because after suspension also price is not stopping. So how we can say that if we can discontinue cotton futures from the derivative market and price will start falling, or price will start cooling down. So there is no case actually. Even I would like to quote some government data here. In economic survey just released by Government of India, I'm just quoting here. India also imports substantial share of its consumption of edible oil. Any change in international price of palm oil get transmitted into domestic prices, as there is correlation is around 0.9. So this is exact quote from economic survey. Niti Aayog CEO Mr. Amitabh Kant recently in an event organized by Pulses Association, he also mentioned during his speech that for farmers to get a better price realization and to manage their price risk better, it is important to have a futures market. So there seems to be some contradiction from different quarters. So I just wanted to highlight these things. Open and efficient market is the need of the day, because economy is open. We are exposed to the not only domestic factors, domestic price risk or domestic demand supply, but also to the global factors. So not having a futures contract or not having derivative contract is not a solution. Actually, it is opposite to the solution. Just a little introduction of the CPO contracts. Both option contract, it is going to be over last contract which is there on the exchange is April contract, and unless suspension is revoked, it won't be there on the screen till 19 December 2022. So there is suspension for 1 year. CPO is a both option contract with basis center at Kandla, and it is it actually it was launched in 2008, and since then as it achieved lot many milestone, and the participation from value chain across the board we have seen. And if I can tell you one more highlight about the value chain participation, it is approximately or higher than 50%. Participation in CPO contract was from the value chain, means from the physical actual user or buyer or seller or processor, those kind of people. So it was a very, very balanced commodity. I'm using past tense here. It was, so it is strange to me. But anyway, this is the fact of the life. So hopefully it will come back sooner rather than later. Next is Mentha oil. It is a compulsory delivery contract. I'm not going much into detail. It has 2 delivery centers, one in Chandosi, another is Barabanki. Contract is doing decent well. There was some restriction here also in Mentha oil. It was doing great volume and great participation. But after the policy revision, by which open position limit in a narrow commodity was reduced substantially to 1/3 of earlier, participation volume in Mentha oil started dwindling. But we have recently seen some good participation after we changed contract from denomination of 6 drums to 2 drums. However, it is still not up to the mark, but at least we are seeing some positive sign, and volume participation, stocks, delivery, everything is started growing. So hopefully soon we'll see the level which we have seen earlier. Rubber contract is introduced recently in December 2020. As of now, it has only one delivery center in Palakkad. So as contract grows and participation volume increases, probably will increase delivery centers also. It is a compulsory delivery contract. Now I'll come to cotton, because as of now, since discontinuation of CPO, cotton is the most traded commodity on MCX in agriculture segment. Fundamentals have already been discussed. The largest India is the largest producer, and second is very unique situation in cotton. It is India is the largest producer, second largest consumer, and third largest exporter of cotton. So there is first, second, and third, all important aspect. And Gujarat, Maharashtra, Telangana are the major producing states in India, and ICE and GC are major global exchange, and MCX is also in India. MCX is the largest exchange in terms of cotton fiber trading, the compulsory delivery contract. However, Ms. Panikar already discussed the CAI estimate, so I'm not going into discussing that estimate again. However, I would like to highlight the USDA estimate for the global demand and supply. We have seen the price rise of cotton not only in India but globally. Similar trend has been similar trend. What do you see here in MCX cotton? The similar trend we can see in ICE. However, the premium discount keeps changing depending upon differential demand supply. However, the trend remains the same, and correlation has been very, very high between ICE cotton and MCX cotton. As you have already seen, must be aware about this estimate of the production, which was already on lower side. In December, USDA estimated 18.28 million metric ton of cotton production, which was reduced to 17.62 and further reduced in February to 17.62 million metric ton. And it resulted, however, this is for USA. Ending stock, however, whatever ending stock was down in January, that was 3.2 million metric ton. It again went up to 3.5, but largely because of change in export number. They are now expecting lower export because of price increase in price. So ending stock is more or less similar to the December estimate for USA, but for world, ending stock is very much down. Production is down from 120.96 million metric ton. That was in January 2022 estimate. That was also down by 0.61 from December estimate. So it continuously for 2-3, if you go backward, 2-3 estimates is coming down for production. Ending stock again, January it was reduced by 0.72 million metric ton. It was further reduced by 0.71 million metric ton in February estimate. So production, ending stock, these numbers are very much showing why prices are rising, and there is hardly any exchange or any market can do when demand is at high. Very CI numbers. If you say India number, I'm just talking about this demand and supply, just two numbers. Or ending stock, you can see that summarize everything. Ending stock 75 lakh bales 2021, and now it is 45.13 lakh bales. So that summarizes all this beginning stock, production, import, export, supply, everything is summarized in ending stock. It shows why the prices are rising. However, there is price has cooled down yesterday and today, but overall still cotton price is all towards the all-time high kind of prices. I'm not going to these details. This is just USDA estimate. I just wanted to show it to you. I'm not going to all the numbers, but just picture which I was trying to draw here. The price rise in cotton or CPO or whatever commodity it is happening, it is all about demand supply, and the numbers are supporting those price rise. And Chandrasekhar sir also said, market is the best judge for the price, and whatever is the price actually that is derived from the demand supply situation of the market. It may be domestic, it may be global, but that is the only criteria which has a final say in the market. Cotton contract is a 25 bill contract. Just brief introduction about cotton contract. Most of you maybe who are trading in MCS may be knowing it. So this is 25 bill contract, and we have many delivery centers here. And cotton is a compulsory delivery contract. And we have main delivery center in Rajkot and additional delivery center in Mundra, Kadi, Jalna, Yavatmal, and Adilabad. Except in Mundra, there are discounts for delivery in these additional delivery centers. Recently, we have also modified the modified contract for this quality parameters. Earlier we used to take HVI middling for this color grade. Now, since this year, we have modified the contract based on the market feedback, and now we are taking this RD value and plus P for this for the price discovery and for the quality delivery process. There is a premium discount also, and foreign matter is also reduced by 0.5%. So apart from that, contract remains the same of the last year. So only in quality parameter there has been 2 revision. Especially this RD value is a major RD value plus B from HVI is a major change in the contract. However, market has accepted that change, and we have seen that in our stocks and delivery, which is happening on the exchange platform. This is the cost structure for delivery on MCX platform. The standard deduction, the storage cost is 2.3 rupees per bale per day. And QC charges, we had 2 quality certification agency, Wakefield and Atira, and 875 rupees per bale is the quality certification charge. Apart from these, there are CCRL charge, 0.02% for deposit. So these things I've already discussed. Exchange delivery, we as of now, stock as of now is in process 15,400 bales, and this is updated till mid of February. Stock eligible for exchange delivery is more approximately 1.5 lakh bales. So doing decent in terms of stocks, delivery, and participation. Cotton also attracts a lot of value chain participant. Approximately 45–40% of participation on exchange is from the value chain side. So there is only any participation value chain of more than 40–50% is very good number. If you see international exchanges, the global exchanges, participation value chain is not that ratio is not that great. However, their numbers are very big. This is only last point which I am trying to highlight here is there may be some people in the audience who are associated with the farming. For them, exchange offers a lot of benefits to the FPOs if they participate on exchange platform through FPO route. There are hard for delivery and trading purpose. Almost all the costs are almost. I'm not saying all. Almost all the costs are reimbursable, whether it's assaying charge, warehouse rent, transportation, up to 50%. The mark to market, broking, even brokerage fee, what you pay to the broker, like Phillip Capital or our member. If you open an account with Phillip Capital and you are an FPO, you pay the brokerage, but you can get it reimbursed from the exchange. So repository fee, Mandi tax. So for FPO and farmers, we are giving a lot of benefits, but farmers has to come from FPO route only. So overall, thank you very much. And there is, I will hand it over to Chandrasekhar sir, and we'll be happy to take your question, whichever at the end. Thank you very much, sir.
Thank you, Sunil Kumar, for such a exhaustive and pointed presentation. You covered a number of commodities of interest to MCX, and I think good input for all the participants. I'm now going to invite our Madan Sabnavis, Chief Economist, Bank of Baroda. He keeps track of the economy like no one else, and I'm sure he's going to share his thoughts about the outlook for agriculture commodities in general, possibly where is inflation going, how is it going to hurt, will we have any relief from inflation?
Yeah, thanks a lot. Thanks a lot, Chandrasekhar, and good evening to everyone. In the current financial year, we have heard of certain interesting things, looking at various data points and announcements made. So the first thing which we hear is that I think this happened last week when the Ministry of Agriculture released their second advanced estimates, where I think we have been talking in terms of having an all-time high record of production of cereals, food grains. Yes. So everything seems to be very good. And I think the only number which didn't look good was cotton. And there I think Chandrasekhar and Rajni had a different view, that maybe the number is not, I mean, there's a different way of calculating it. Anyway, that's one part of the story. Second, we've also heard SkyMet say that the monsoon is going to be normal for 22. So that also seems to be very good news. Now, if I go back the last 6 years, I think we've had very good monsoons. So I think economists always say that if I have 6 good monsoons, the probability of having a bad monsoon on the 7th is very high. But we have been saying it for the last so many years, and we've always been having good monsoons. But does this really matter at the end of the day? Because today, when we are talking of commodity prices, especially prices of agricultural commodities, we have seen that the prices have been going up. And our normal common sense logic, which says that excess supply should lead to prices coming down, is not quite happening. I was just looking at the latest WPI numbers, which came in on the 14th. And we were told that food inflation is around 10.3%. So we're in a double-digit range. This is the primary articles. When I look at the manufactured articles, it's around 8.1%, that is manufactured food products. Within that, I have edible oils, which are 13.8%. I look at the consumer price index to see how has that inflation fared. And we look at the entire thing of food and beverages, it's around 5.9%. And within that, if I look at the manufactured products, it's something like 6.4%. So clearly there is something going on where conventional theory has been turned around, and we have seen that even though there has been very good production, we are not seeing prices actually coming down. Forget about prices coming down. Inflation is not coming down. We are seeing that inflation for various food items have been going up, especially if I look at edible oils. Pulses have not been that dramatic, but if I look at WPI, I see that even pulses have been going up around 5 to 6%. So when I'm having an all-time high production of tur and of moong, of urad, why should the prices actually be going up? So when you keep these factors in mind, I think the thought which comes to me is that we can no longer say that because there is a good monsoon, there's going to be a very good crop. And if there's a very good crop, we're going to have stable prices. I think that is the basic assumption which is made in monetary policy when the experts sit there and they say that since agricultural production is expected to be good, we expect inflation to remain stable, benign, and accordingly a number is arrived at. Now, the basic problem which we have had here is that 2020, we had the pandemic. 2021 was the so-called recovery. So when we had the pandemic, of course, consumption came down for obvious reasons. And in 2021, there was a major revival which took place in the global economy, something which has translated into high growth numbers in various economies. To the extent that the Federal Reserve is now saying that we need to increase interest rates to contain inflation, which is running at around 7.5 to 8%. Now, the essential thing is that we have seen that the prices of agricultural commodities have gone up because I would tend to believe that there are a number of services which were hitherto closed had started opening up when the economies revived. For example, some of the largest consumers of edible oils besides the households, who we probably continued consuming as much as we were doing earlier, but there were definitely things like the hospitality industry, the airline industry, offices. I think that's where a lot of these food products, processed food products actually come in. And we had seen that a sudden upheaval in terms of the demand had led to demand going up, supply not keeping pace. And accordingly, we've seen that the prices started moving up. Now, when the prices move up, of course, that's one part to say that the primary producers were better off because the prices of oil seeds went up, the prices of corn went up, wheat went up. But the other issue is that as a producer of processed commodities, food commodities, here are all these raw materials. These are all raw materials which I'm using in order to produce whatever I'm doing. I could be a biscuit manufacturer. I could be producing edible oils directly, or any of these food products, which your wafers and so on and so forth. Now, I've seen that the cost of my products have actually gone up. The cost of my raw materials have gone up. And there's a whole question of saying that, do I pass on the price increase to the consumer, or do I hold on to it? So what we saw was that for the first year or so in 2020-21, most of the companies, now when I say most of the companies, it's again based on the presentations which companies in this particular industry, they keep making these presentations in their quarterly results. So they have started saying in the last 2 quarters, that is September quarter and the December quarter, that they had absorbed a lot of this high price of raw materials and finally decided that it was time to pass on the cost to the consumer. So either the prices were increased or they reduced the size of their packages to make sure that the prices remain the same, but in terms of their overall higher raw material or input costs were really absorbed up here. So therefore, we have two things which are happening. One is that prices of primary products went up, and second, the users of these primary products, which is the manufacturing sector, they were the ones who were finally at some point of time they had to pass on the prices. So in this kind of a scenario, how do we look at 22-23? So I'm not really giving too much of importance to the good monsoon. Okay, we have a good monsoon every year. We have an onion shortage every year. Onion prices will go up, tomato prices will go up, and we will be having high food inflation every year, which doesn't get counted under the Ministry of Agriculture's first, second, third, fourth advance estimates. So inflation will continue to be high because I believe that the kind of resurgence which we saw in demand for agricultural products in 2021 will be fully consummated in the year 22. So that is because we've had these various lockdowns, lockdown 2, lockdown 3, which affected basically the service sector, the ones which actually do contribute substantially to the demand for these products. And as this becomes more and more normal as we get into 2022, the demand supply imbalance is going to continue to be there. Now, exactly depending upon what would be the production numbers of commodities, there could be a kind of spike in prices. So therefore, this kind of an inflation in the region of 5 to 7% for agricultural commodities on the whole can be expected to persist for one more year. Now, another thing which we saw happening was that when we are talking of things like pulses, we had very good production, and this doesn't really go in as okay, some of it goes into your inputs, like a chana does go into inputs when you use besan for mithai or for your farsan. But most of these commodities are consumed by the households directly. But why should I see my prices really go up? So here again, it goes back to saying that we've had the MSP which comes into the picture. As long as the government continues to increase the MSP, of course, in 21 for both Kharif and Rabi, we have not seen a very substantial increase in your MSPs, but definitely we have seen an increase in the region of around 3 to 7% and an average of around 5%. So that is something which will continue to exert prices on the final price. So we will continue paying higher prices. And I think it's a no-brainer to say that MSPs are going to be increased once more because there will always be some elections or the other coming up, and the governments always prepare for it by increasing MSPs, so they put the prices for. But the actual worrying factor is something which I think has been mentioned by all the my previous speakers, is about the ban on futures trading. Because when we are looking at the corporate sector, people are producing these food products. I think one of the major ways in which they were able to cover up for these higher raw material costs was through the hedging process on the futures exchanges. Now, what we have seen is that commodities like chana, mustard, soya, palm oil, I think there's 7 of them, rice, wheat didn't matter too much. But we have seen that these commodities have been banned, which means that in effect, we are saying that companies who should be actually hedging their price risk, and mind you, I think it's now mandatory for all companies to mention in their annual reports as to what are they doing for commodity risk management. Okay, so it's not mandatory for you to do the hedging part, but you're supposed to say whether you've done it or not. Now, by removing this particular mechanism through which you can do a hedging, I think this is going to be a major problem for lots of these companies, because I could actually argue around and say that the higher prices we are paying for our packet of wafers or for even our edible oils is that maybe in case there was active hedging which could have been done by these companies. Of course, it didn't hold for a large part of it. This happened more towards the end of 2021. But going ahead in 2022, this will definitely be an issue, that if you're not able to do this hedging on international platforms, then there will definitely be a case of saying that we will be having with high food inflation, both from the primary as well as the secondary level, that is at the final product level. So I think this is something which has to be seriously reconsidered by the appropriate authorities. I remember in 2007, 2008, we had the similar controversy which came up, and there was an expert committee of Abhijit Sen, which actually found out that there was not much of a correlation between the two of them, futures prices and the spot prices. And we need to have these studies coming up regularly. And I think this should be something which should be instituted more as a matter of routine, so that every time there is this controversy which comes about, about food prices going up, agricultural prices going up, and the futures market bearing the brunt of it. I think that is something which should be avoided in future. Because what we have noticed is that the kind of progress which was made by the commodity derivative exchanges was primarily on account of A, the hedging which was being done, and second, we also saw a number of farmer producer organizations actually coming and hedging it. So there we are talking of farmers being in a position to hedge, companies being in a position to hedge, so that gradually over a period of time, you have more of the users of commodities, people who deal in commodities, rather than those who are the ones who work in terms of making the markets, or who very loosely are called maybe speculators or arbitragers. But that's this kind of proportion we need to make sure that it's only with time that it happens. Like as people have more confidence in the markets, we'll see more participation coming from this particular segment. So quite clearly, the signal is that we are going to have another year of upward movement in prices. And today we have seen this battle which is possibly going on between Russia and Ukraine. They are major contributors to the global market for both wheat and corn. I think Chandrasekhar can correct me, he's an expert in Ukraine. So this would actually mean that there will be quite a bit of upheaval even in terms of international prices, where we may not be directly affected. But finally, at the end of the day, we've seen that whether or not we import a commodity, there is some kind of an impact which is also felt on domestic prices. So we should be prepared for higher prices of agricultural commodities. And more importantly, I think we need to get back this business of futures trading. And these are commodities which are doing very well. We had very good participation from the market. All kinds of players are there. And more importantly, some of the major producers of manufactured food products were the ones who were participating. So I think removing the ban immediately and ensuring that things are back to normal will definitely help to stabilize prices going ahead. Thank you.
Thank you. Thank you, Madan, as always, very precise. But what is somewhat disturbing is your view, your observation that given the supply-demand mismatches and geopolitical instabilities, don't expect any big relief in inflation. I think that's the kind of that's what you had expressed. Yes, of course, there's a substantial merit in what you said. But I want to share one or two thoughts with the participants. While we have to expect continued volatility in the global agriculture commodity markets, but if we look beyond the first half of this year into the second half of 2022, we have to take on board 2 or 3 or 4 factors. Number one is very clearly the high probability of a rebound in agriculture commodity production in the second half of the year in the northern hemisphere. This is one. Second, the tapering by the US Fed, which is going to reduce liquidity, and at least there'll be 4 increases in interest rate is what they are talking about, will also have a certain impact on the dollars available, and of course on the dollar. Dollar is substantially strengthened, and it will remain strong with further strengthening with very limited space. Further upward momentum in dollar will be limited because it's already gotten quite strong. But the tapering and reduction in liquidity, I'm sure, will have an impact on various asset prices. This is my belief, and I think we're seeing the effect of that already. The joker in the pack in recent times is, of course, the Russia-Ukraine conflict. In fact, my sense is the world cannot afford a war, and I don't know, but I don't think Putin is stupid. War, because that's going to more instabilities. There'll be a lot of grandstanding and threatening, but actual war, I don't know. I mean, I would personally want to discount that. If the tempers cool off over the next a few days or a few weeks, obviously there'll be a definite correction in the energy market as a whole, both the crude oil and natural gas. which will again to some extent contribute to taming of inflation. And hopefully the shipping and logistics issues are slowly, very slowly, painfully slowly, I must say, getting sorted out, but they're getting sorted out nonetheless. So when we put all this together, lower liquidity, higher interest rates, stronger dollar, improving logistics situation, the possibility of a bigger North Hemisphere crop in the second half of the year. When you put all this together, yes, first half, be ready for continued volatility, but there can potentially be a relief for agriculture commodities in the second half of the year. Is what I'm, which is what is my sense. Now, to what extent all that is going to have an impact on the domestic market, particularly if we talk of cotton and palm oil, these are both internationally benchmarked commodities for India. I just want to very quickly, I just wrote out palm oil, vegetable oil market fundamentals. According to the USDA, global production in 22 will be 213 million tons, which is 7 million tons higher than it was in 21. Whereas consumption will be only 210 million ton. Therefore, there is a 3 million ton this year's surplus supply available. Palm oil, if we look at 75.5 million tons production, 2.5 million tons higher than it was last year. Whereas palm oil consumption will be less than 74 million, and then raise the end stocks marginally. For if we put this, palm oil's peak season will start from April onwards, but they have this plantation labor problem in Malaysia. For it will take some time for that to get adjusted. Possibly April, May, June, hopefully their production should pick up and start normalizing. Therefore, I hope that in the second half of the year, there will be a propensity for higher supplies, stronger dollar, high interest rates, and therefore there is a possibility of a correction, because the current high prices are also driven by speculative capital to a large extent. That capital will start exiting once signals are available that the markets are ready for correction. This is what this is my view. But very quickly, let's go into the chat mode and see if there are any questions. Post your questions. Can you please provide inputs on pulses and fruit export? No, I think the question is quite vague. What input Mr. Chetan Badguzar is asking, I don't understand. But pulses, of course, our production, again, in my view, very personal view, India's production is overstated. Production is, in my view, it is only about 22 or 22.5 million tons. We will continue to import at least 2 to 2.5 million tons, even in 22-23. In edible oil, when do you see backwardation convert into contango? As I think I mentioned, in the second half of the year, you can expect some relief in edible oil prices, but we are not discussing price outlook here. Will there be price rise in crude oil due to global impact? Well, because of the geopolitical impact, crude oil prices are still already very high, and therefore, once the tempers start cooling, obviously there could be correction in the crude oil prices. Will the tightening monetary policy help tame inflation? It's one of the contributory factors that can potentially help tame inflation. That cannot be the only factor, but it can be one of the factors. I think with this, I think I must go back to all the panelists very quickly in 1 or 2 minutes. Rajini, you have something to say? Then I'll check with Sunil Kumar and of course Madan also. Very quickly, any you want to round up with your views, comments?
Yeah, I mean, I will round up by saying that we are expecting, just like you have summarized, that there should be a cooling off prices potentially as supply increases in terms of increased acreage. Some amount of demand destruction, of course, coming in. Though Madan has said that it's more like the balancing of the demand that did come down during the pandemic times, and the supply may take time to catch up to this demand, but we are expecting, because these are record high prices, therefore, the increase in supply, taming the current high prices that we are seeing, and all the other global macros that you mentioned.
Thanks, Ma. Very clearly, don't expect any collapse in price. Let's be very clear.
Yeah.
Prices will stay at elevated levels, but from the current level, there could be correction, and
yeah, perhaps the worst is behind us, hopefully.
Yeah. Sunil, any passing comments from
Yes,
your
sir.
side?
Yeah, thank you. I think my last submission would be what we are seeing that from the demand supply situation, and that was going to rule the market, and hopefully any artificial measures to cool the prices, hopefully it may work for short period of time, but eventually demand and supply dynamics will overtake. So if the government and or industry is worried about the price rise, then only solution what we have is to increase the supply line or dependence on the import in the edible oil segment. That is my take on this prices which we are seeing recently in domestic and global market.
All right, thank you very much. Madan, any closing comments from your
Yeah,
side?
just a quick one. As I said in the beginning, that the relationship between good monsoon output and prices will remain severed for another year.
Yeah.
And hopefully, in case we do have restoration of all the futures contracts, I think people should keep seeing what's happening on the MCX trading platform to see. That will give you a better idea about how prices are moving, rather than going on the basis of
completely agree. But before I invite IMC's former president Anil Bhai Kilachan, I want Anita to share the screen, which has now become mandatory. All the views expressed here are all personal views. They do not, certainly in my case, these are my personal views, and certainly Sunil Kumar's views are personal views, and therefore, I think it's very important for us to give the disclaimer. Okay, Anita, go to the next one. Next, Anita. Yeah, the second slide. I think there is the next one. Yeah, I think there are the SEBI has come up. SEBI and NISM, they have come up with some scheme. Maybe you can. There's a quiz program. Look at the NISM website, and you will get all the information. Now, with this, I'll now invite a very senior industry representative, Sunil Kilachan, to propose a vote of thanks.
Thank you, Chandrasekhar. As usual, this was a very informative webinar, and I enjoyed the participation as well as the speakers panel, which gave us a very interesting bird's eye view of what is happening in the agricultural commodity market. The price today being high, everything being uncertain, volatility, global impact on prices, and the particular factors affecting imports and exports have become very much more important than earlier. Supply demand, of course, will always be a query to be resolved, but the market is there to do that. But the contribution that institutions like MCX make to make this volatility such that it can be manageable, and the idea of risk management and futures trading available to all the business people and companies who are involved in agricultural commodities is a very important factor to consider. And it should be encouraged to be a participation by all the people interested in agri prices in any form, whether consumers, producers, or farmers. And I commend the role MCX is playing, and we are very happy in Chamber that we have joined hands with MCX and become an accredited training agency as well as for risk management. With this, I would like to thank once again all the speakers, Ms. Rajni Panikar, Sunil Kumar, Madan Fadnavis, and Chandrasekhar, our own economic advisor. Thank you once and for all, and thank you for participating in this invitation to present. Thank you.
Thank you, sir. Good luck.
Thank
God
you.
bless you all.
Thank you. Thank you.
Thank you.